Good evening, everyone who are joining from Singapore, and good afternoon for folks joining from India. On behalf of TiE Singapore, we welcome you to today's session, discussion on tax implications of cross-border investments, organized by TiE Singapore in collaboration with LCR partners. Moderator for today's session is Shilpa Menon, Senior Director, India, LCR Capital Partners. Over to you, Shilpa.
Thank you so much, Sudha. It's a pleasure to be here today, and I welcome all of you from India and Singapore, wherever else you may have logged in, and good afternoon, good evening, according to your time zones. Before we begin into this session, and I'm sure a lot of people have come in with a lot of questions, but before that, would love to introduce very shortly LCR Capital and, of course, our distinguished guests on the panel today. LCR Capital is actually a private investment and advisory services firm headquartered in Westport, Connecticut. We have 6 other office locations, including one in Mumbai, one in Dubai, and one in Singapore. We are primarily focusing on alternative residency products, such as immigrant investor programs, including the EB-5, Portugal Golden Visa, etc. And over the last few years, we've also expanded our offerings to include global wealth management solutions. That's a little bit about us. Now I would want to introduce our speakers here, Sridhar and Lloyd from Grant Thornton, Bharat. Grant Thornton is a member of Grant Thornton International, which really does not need much introduction. It's one of the preeminent Indian professional services firm. They're one of the largest fully integrated assurance, tax, and advisory firms in India, and they have over 5,600 people and presence in around 15 countries. I'll briefly introduce each of them. Sridhar is tax partner at Grant Thornton, Bharat, and where he's responsible for the tax practice of Chennai and the Kochi offices. He's also responsible for the transaction tax practice of the firm for South India. He has over 24 years of post-qualification experience in tax and regulatory matters. A significant part of his career was spent in Delhi, where he gained expertise in dealing with complex and varied tax and regulatory matters of multinational corporations. He shifted to Chennai in 2006, and prior to joining GTB, he ran a boutique consulting firm which specialized in tax, regulatory, and M&A functions. A little bit about Lloyd. He's partner and leader of the US tax services at GTB. He focuses on the US corporate and individual tax advisory and compliance. He's got a lot of experience in assisting Indian companies in setting up their US operations and also managing the entire range of US tax compliance requirements. He specializes in both corporate and individual tax returns in the US M&A tax advisory, tax due diligence, international tax planning, what have you. So he's essentially, in a nutshell, a US tax expert. That's a little bit about all of us over here on this panel. And I think without much ado, I would like to really launch into this fireside chat that we planned here. At LCR Capital, we're definitely seeing a significant increase in the number of families wanting to go global. When I say wanting to go global, I mean 2 or 3 things primarily. One is that people are looking actively at alternative residencies, trying to invest to get a foothold in another country, which is not their home country. Second is, of course, portfolio diversification, right? A lot of families do believe with their asset base, it does not bode well to stay out of one of the largest markets, equity capital markets. For example, the US has around 60%. It commands 60% of the equity capital markets in the world. So it definitely makes sense to start diversifying your portfolio outside your home country. Third, of course, access to global ideas. Your home country may not have access to all of the ideas that you want to invest in. And definitely you must go where, what investment excites you, and that may not always be in your home country. So these are the reasons why primarily we're seeing a lot of families looking outwards. And for the purpose of today's discussion, we're going to focus a little bit more on the US side of investments, US geography, and also looking more deeply into what impacts Indians and non-resident Indians, because there are specific regulations that, as you all know, apply to us, which is the LRS, FEMA, etc., right, which is probably not such a big problem for other nationalities. So with that, let me first ask a very open-ended question to you, Sridhar. What should Indian residents and NRIs take into consideration from a tax and regulatory perspective when they are trying to make an offshore transaction? Now, I'm right now only talking about offshore transaction, not talking about US specifically. Whenever they're looking to invest outside, what are the first few things that they need to take care of?
Yeah, so Shilpa, I think as you know, the legal and regulatory framework in India is very unique to the extent that there is an exchange control law, which kind of plays out as a framework for us to consider. And then tax obviously is a consequence, but an important one. And therefore, so if we were to look at the framework under exchange control law, we've moved quite a few strides into making things more liberal. But exchange control law has had a history of invoking fear in investors as well as in people's minds. So to dispel the fear, at least from a framework perspective, individual residents are permitted to invest up to USD $250,000 in multiple instruments and or assets, including equity shares and or investments in trusts or immovable property, etc. And that limit is per person per year. And that is for applicable to any investments that go out from the country as a resident. And the definition of a resident in exchange control law is slightly different from that that is used in income tax. But that is the primary framework that you need to bear in mind. The second thing you need to know is there is a separate set of framework that applies to strategic investments, especially by corporates. And therefore, a lot of investments that go out as promoters are seen in a different lens as compared to the liberalized remittance scheme or the LRS window. So these are two distinct windows that apply with their own conditions, and they have to kind of be measured independently. That's as far as the exchange control law is concerned. Tax, India loves to tax any asset held by a resident. So we will not let go of that right. And therefore, any direct ownership by a resident of an overseas asset and that any return on account of that, whether by way of dividend or by way of capital gain on the sale, will be liable to tax in India if that individual is a tax resident of India. And that's really this kind of framework that broadly applies in all situations.
Understood. I think that's useful. I think follow-up question to Lloyd. Those who are looking to invest specifically in the US, what are the tax implications? And Sridhar did mention that India loves to tax. What happens? Do they end up paying tax in the US and India both?
So interestingly, while US is known to be also a jurisdiction which has its own fancy for taxing everything they can, but particularly for non-residents investing in securities, they buy shares of a US company, for example, as an Indian resident or a Singapore resident. If you buy, let's say, shares of Apple or Google, capital gains will not be taxable in the US if you are not a US resident. If you don't have a green card, you don't have a US citizen, you're a foreign citizen, you're living outside the US, capital gains will not be taxable in the US in most companies. There are certain exceptions. If you're investing in real estate owning companies where more than 50% of the value is derived by US real estate, then they want to tax it. Obviously, if you buy a house in the US or you make any specific tangible investments in the US, there could be both federal and state implications. But from a securities perspective, from a pure portfolio diversification perspective, if you're investing in the US stock markets, there will be no tax on capital gains. You will still be taxed on any dividends that you receive. So there will be withholding taxes based on where you are coming from. The applicable treaties will apply. But capital gains is a sweet spot where there will be no income tax element there. But here's the catch, okay? Although no income tax is applicable, the US still considers US equity as an asset for estate duty purposes. So therefore, non-residents investing in the US markets, it's important to plan around this aspect. The threshold for estate duty for non-citizens is a very, very small amount, it's $60,000 US. So if you own more than $60,000 of US stock, and that stock is passed on to your next of kin upon your demise, then the US estate duty will kick in. So while there's no income tax on capital gains derived from selling shares on the US markets, estate duty is something that definitely needs to be planned for.
That's very, very insightful. Since we are on the TiE platform, our audience obviously comes from an entrepreneurial background. Are there any additional considerations that we should take into account when they're starting a business overseas from an Indian or US regulatory tax perspective? Sridhar, maybe you can answer that.
Yeah. So Shilpa, like I said, the hat that you wear matters. So if you are investing as a promoter, there are some conditions that you need to be wary of. The limit of an individual still remains at the $250,000, and it's a subsumed limit. So everything else also gets included, including your investment as a promoter. But the key element here is that as a promoter of a foreign company, that foreign company should be only in active business, one. And two, that company cannot then have step-down subsidiaries anywhere in the world. And this is a condition which a lot of people miss in making, and this is classified as overseas direct investments by individuals. So there's a class of investors as individuals which allow you to do this. There is flexibility for individuals to become promoters of foreign companies, but there is this rule that RBI will not allow a step-down subsidiary below that entity, and the $250,000 still applies to that individual's ownership in that company. Of course, it's an annual limit, so there is a reset, and therefore investments can happen over a period of time. And it is very much possible that 5 individuals or 6 individuals, all of you join together and do this investment under the overseas direct investment route. That's a distinct route. And of course, if you were to use a pooling vehicle in India, which means you set up an entity in India, that in itself is a distinct overseas direct investment window, which allows you to measure the limit basis the net worth of the entity in India, and 4 times of the net worth of the Indian vehicle that you create. So if you create a company, 4 times of its net worth is the possibility for such an entity to invest overseas. And as a legal entity, you can still have step down subsidiaries, and there are no restrictions there. And therefore, the flexible way of investing overseas has always been routing investments through company forms in India, and that's been the preference as such. But yes, these are 2 distinct windows, and you need to be wary of especially investments as residents when you do this. But if you were at any point a non-resident, and if you had saved sufficient money from your earnings as a non-resident, your coming back to India doesn't make that saving a resident investment. So you are outside of the requirement of exchange control law compliance if you held assets or bank accounts or money in an overseas account from what you saved in the past as a non-resident. So these are 3 distinct possibilities that kind of roll out, and each of them kind of play out in their own way.
Right. So I think coming back to your ODI that you're talking about, the pooled one, can the entity then invest directly outside in the US, for example, or is it required that it only invests in the industry that it is, or the segment that it is in India? That is the question a lot of people ask.
Right. Shilpa, the linked question is, if you are investing overseas in a financial services sector, there are distinct conditions. India is put an additional condition that in outbound investment in financial services that are regulated overseas should also be done by somebody who's regulated by the Indian country's regulator, that is the Reserve Bank or the insurance regulator or any of the other financial services regulators. So for financial services, there is a higher benchmark and threshold to make overseas investments. For other investments in other sectors, pretty much flat. There is no restriction in moving around in businesses. Real estate in itself is a prohibition, so you need to be wary of real estate and financial services, really how we would classify it in restriction.
Got it. So, under the LRS, is there any restriction on what kind of instruments you can invest in, or there is also the issue of round tripping? It would be great if you can just highlight all of that.
Yeah. So in LRS, an individual is permitted to invest in listed shares as well as unlisted company shares, and in a limited way, they are also allowed to invest in pooling vehicle instruments like trust units, as well as debt instruments. So any securities in that definition kind of broadly fits into the understanding of LRS investments. Again, LRS, like I said, is also broken out into strategic and non-strategic investments. Strategic investments are only in equity, and if you get measured in ODI, overseas direct investments, you are measured only for equity investments. You can't give a loan from the LRS under the LRS window. Non-strategic is portfolio in nature, and therefore even listed stock and securities are also covered there, and you're free to take a investor's view on such investments, such assets.
Got it. And what are the LRS and FEMA restrictions when it comes to close family members? If they are pooling LRS money and they want to together invest in an asset, what should they keep in mind?
So LRS as a window allows a family to kind of club all its investments together for a larger investment threshold. So $250,000 applies per individual family member. But there is some catch in the way this is actually implemented, especially in terms of how the investments are made from that pool, because there is an expectation that the asset tags to a particular individual within the family as well, or it is jointly held to reflect the fact that you pooled this when you made the joint investment. And therefore, there is an expectation that it cannot be that one individual holds all the assets using the pool of a family. It is therefore suggested and right for all of the individuals to hold those assets jointly if they have kind of pooled this together. And there are some nuances on if you were to have a bank account abroad to do this. So the cash sits overseas, but it is used to pool this the money and then used to invest. The investment in itself still needs to meet the criteria of joint ownership, whereas the money pooling into the bank account is something that is fungible. So the $250,000 doesn't distinguish who sent the money out at the immediate level.
Understood. So basically, that is more like a path to finally invest, and I think the final investment needs to be jointly held. Lloyd, coming to you, there are some people who get a little bit confused on tax residency versus actually getting a green card or getting. In case of US, of course, it's similar. Getting green card is equal to tax residency. But does getting a citizenship of a country means you automatically become a tax resident, or if you get a PR or like a golden visa or something, do you become automatically a tax resident of that place, or what requires?
So, all countries have different rules, and US is one among only, I think, 2 or 3 countries in the world which has a citizenship-based taxation. India also, we are largely on a residency based, not really citizenship based. Although we have some nuances now where we are looking to get some levers there. But largely, when I talk about the US, it is based on citizenship as well as based on the green card. So if you get a green card, of course, you become a US tax resident, even though you are not staying in the US. So physically, you may be living overseas. But the moment you get a green card, your tax residency, in that effect will start. If you were born in the US, you have a US passport, and you are a US citizen, then also, you're liable to taxes on your global income. Accidental Americans is a term that they usually use for people who are just born in the US and moved overseas. So in that sense, the US doesn't really care whether you're spending time in the country or not. If you are a green card holder, if you are a US passport holder, you are subject to US taxes, and that too on your global incomes. Yes, there are tax treaties that can limit the impact in some cases on certain categories of income. But by and large, you're entitled to not only report your global income to tax in the US, but there's a whole host of disclosure obligations. So all your foreign financial assets that you hold, and there's a great degree of disclosure that is required if you're filing US taxes.
Understood. And from a residency by investment perspective, when does an investor become liable to file and pay taxes in the US? I guess it's when they would get their green card in hand, right?
Yes. So particularly in the investment visa regime, there is a sort of a wait period from the time the investment is made till the time the individual actually gets the green card. So there is, in fact, once they get the in-principle approval, they have sort of a 6-month window to step foot in the US. So it's basically when they land on US shores in a particular year is when their green card takes effect, and therefore their tax residency starts. So that year is important, and that year you would be what is called a dual resident, because for a certain portion of the year you would be a non-resident, certain portion you'd be a resident, and taxes work slightly differently there. So it's important to be careful in that year. And it's also a planning opportunity, because there are a lot of things that can be done before you actually trigger your residency. So the year in which you get the green card is an important year, and a good amount of planning can help in optimizing your tax situation there.
Understood. And coming back to you, Sridhar, you talked about the LRS for residents, right? I mean, there are some regulations on the NRIs and how much they can actually repatriate. I believe they can repatriate $1 million in a year, and it's not 250. I just wanted to understand what are the rules here and what are the restrictions? What is the kind of money that they can take money out? Is it something that they completely own or earned, or can it be a gift from somebody in India?
Yeah, so Shilpa, the NRI by definition means that you've gone outside the country, but you are from India origin, and therefore you classify yourself as a person of Indian origin and NRI in that definition. So if you were an NRI, basically you're sitting outside the country and you've earned money in India in the past, and it's parked in a bank account in India typically an NRO or an NRE account. NRO account is what you would park that money into. And the rules therefore allow you to take that up to a $1 million in a year to kind of take that money back to your to the country in which you're staying or where you want to put that into application. And to that extent, India has made it flexible to at least repatriate that much as a legacy resident who can take that money out, having given the fact that he is staying now overseas. So that's the flexibility, and in that, what all is permitted is whatever he had earned or is continuing to earn as a resident, whether it's disposal of assets in India like shares, or whether it is running income like rent or interest or gain on disposal of certain assets. Immovable property, there is a twist in the tail. You can't remit more than proceeds of 2 immovable properties in a lifetime, and you'll have to elect for you to be able to do that. But the $1 million is a reasonably high limit, and RBI permits you to remit other proceeds if there is a fit case to do this. So you can go back to RBI for an approval if you had inherited or you had got an asset which is valued more and you disposed it off. But in principle, 1 million is really what you can take out in a year. And once you've taken it out of the country, you are not measured further on what you do as a non-resident on that asset, and therefore you're free to apply that to earn other income overseas, or you're free to use it in the best way that you think possible. On gifts, once you've taken money out as a non-resident, you're free to gift this to others subject to law of other countries. But if you were to get this as a gift from a resident, then for that resident, the $250,000 limit applies for you to get the gift. So for the resident who's gifting you, he's still subjected to the $250,000 limit.
Understood. So if they would want to remit 500 out, they probably need their 2 people in their family to give them 250 each, right? I mean, technically speaking.
Yeah, and gifting has to kind of, the underlying love and affection should certainly show out, stand out. And that's, because exchange control law is a law of intention as well. So we shouldn't use or possibilities under law for potential misuse. So where there is genuine reason to gift, it's better to justify it and get the money as gift, or otherwise there are other ways to deal with it, but not that gift is the only way to get that answer.
Understood. Makes sense. Lloyd, coming to you, I think some people want to ask if you are in the US and you do give up a US card, green card, is there an exit tax?
Yes. So the US doesn't make giving up the green card also so easy. So there is, however, there are a few exceptions there, and the first exception is if you are not what is called a long-term resident. Long-term resident is once you've held a green card for at least 8 years in the last 15 years, right? And so in the first sort of 7 years, you have a window to exit or give up your green card without being subject to the exit tax. So if you get a green card this year, you have to make sure that before you enter your 8th year, you really make up your mind whether you want to stay in the US or you want to keep your green card for the longer term. So that's the first 7 years sort of get out of jail free card that you should really evaluate. And that is something that we talk to a lot of clients. Again, It's difficult when somebody gets a green card today. It's not that simple to because they've obviously either invested time or money or other things to get that, right. But to take a decision whether in 7 years we will need it, we will not need it, our kids may be studying in the US. It's a difficult decision, I understand. But from a purely economic perspective, a 7-year is a hard stop there. So that is one important date to be aware of. But let's say we are way past that, and we are beyond the 7-year window. We've held the green card for several decades. And now the individual is looking at moving outside the US by giving up the green card. The important consideration of the thresholds there are a couple of thresholds which are important. One is their global net worth threshold, which is $2 million. The second is your average net income tax liability threshold for the last 5 years. And that currently is $171,000 US. So if an individual has a net worth below $2 million, if the last 5 years average tax liability is below $171,000, then basically what the US is saying is you're not really a very, very high income or high net worth taxpayer, and will allow you to exit the US without being subject to exit taxes. But if you are above these thresholds, then tax planning is required. The individuals have what is known as the lifetime exclusion from gift and estate taxes. That's currently about $11.5 billion. It's likely to go up to 12 million next year with inflation. So up to about $12 million, potentially an individual could look at gifting out some of their assets to their family members and try and get themselves below the $2 million limit. Of course, the important part here is they're not tripping the average income tax liability trigger, because there's no way to deal with that. That's a hard metric. And again, to deal with that is sometimes people look at extending that by one more year and trying to ensure that they minimize their incomes in that particular year to fall below the tax liability threshold. If these two things are manageable and these two things are planned for, and this is possible, we have done that in quite a few cases, then we can still work around the exit taxes. But let's say that is also not possible. You are upwards of 100 mil or 200 mil, and it's not possible to practically get to a 2 million below number. Then you have to look at exit taxes. And what exit taxes really mean is if you were to sell all your assets and global assets, if you were to sell all your global assets, what is the mark-to-market gain that is sitting in your global portfolio? Basically, the US is saying, I need my share of taxes on that mark-to-market gain, which you have earned while you are a US person. There is a small exemption threshold. It's around $700,000. So let's say if you have $100 million in net worth, if you were to sell everything you own today, maybe you make 30 million, a deemed capital gain, right? So on that 30 million, they'll give you the base exemption of 700,000. But the balance 29.3 million will be subject to long-term capital gains tax of the US, which is currently 20% plus a 3.8% surcharge. So effectively, you're paying as much as 24% to exit the US. That is one consequence. But there's also another rider. And the other rider is you get a unwanted tag of something which is called a covered expatriate, which basically means that once you have exited the US after paying gift taxes, they don't want such individuals to send or use it as a backdoor channel to send assets back to their US relatives or children or other people that they know. So they will levy a gift tax on the recipient for any assets that have been received from a covered expatriate. So they're saying if you're quitting the US, please go along with your family, relatives, etc., all of it. If you have US, children or other relatives who are expected to inherit assets from you, then those inheritances will also be subject to US estate taxes. And during a lifetime, if they give you certain gifts, covered expatriates give US citizens certain gifts, and those gifts will be taxable. So it can get quite complicated, and therefore a lot of people try as hard as they can to avoid the covered expatriate status. So a lot of work needs to go into that, into how we want to plan around that.
That's very useful, I think, because that's a question that we very frequently hear. Thanks for that, Lloyd. I want to talk a little bit about investors who are contemplating investing in the US. And of course, tax cannot be a deal breaker for somebody who's wanting to invest or changing, they're looking for a change in their lifestyles. So what can they possibly do in terms of planning ahead and optimizing their tax liabilities? I think first Sridhar, you, and then Lloyd, if you could throw some light on how this can be planned, how much time it takes, and what they can possibly do about this.
From an individual tax point of view, tax residency rules in India certainly kind of follow international principles to the extent that anything over 183 days stay in India in a financial year which runs from 1st of April to 31st of March will make the individual most likely a tax resident in India. And therefore, the first thing to check is whether or not such an individual is a resident or not. And if he has stayed in the country for that much period or more, then on what assets is he liable to tax in India is the second question, which as a resident, India wants to tax all of the global income of that individual, with some limited exceptions for not ordinarily resident individuals who are measured in a slightly liberal way to not necessarily tax all of the overseas sourced income. But in principle, that's how India would kind of play this out. And there is obviously, like in any multi-country jurisdiction, if India has a treaty country with whom we have with the individual is resident of, there is a tiebreaker rule as well, where permanent residence is also tested for purposes of treaty benefit. So broadly, those would be the guideline line items that you need to kind of assess. Shilpa, I don't know if I've answered all of your question, but that's the sense I kind of get at a big picture level.
Got that. I mean, Lloyd, would you want to chime in?
Sure. See, we work with a lot of families who are contemplating moving overseas, particularly to the US. And I think there's a good window to do a lot of activities, and it's basically the arbitrage between how India taxes certain assets vis-a-vis how the US does. And India, for all its worth, there are a lot of avenues where we are taxed at a lesser rate than the US, or in some cases not taxed at all. So there are things that individuals can do before they move to the US. Simple things like what we call stepping up the basis in your assets. So if you have, let's say, long-term equity in the stock markets, up until a few years ago, there were no capital gains on long-term, but now we have a limited, capital gains tax with some grandfathering cost benefits. So I think that's important to ensure that, at least you trigger the gains before you leave, for the US, so that you pay only the India liability. And then if required, you buy those assets back. So you're only paying the India taxes on what's perhaps a much smaller tax number. And you still retain those assets from a long-term holding perspective. So we can plan for trying and triggering certain taxes which is more favorable from an India perspective before you move to the US. Other things, like specifically on the estate side, a lot of people look at trusts as a structure to move in assets that they want to leave for either for their parents or for other beneficiaries. Because of the US estate laws. So that's another avenue that needs planning. US does have certain look back rules. Anything that you set up within 5 years of moving to the US, there's an extra layer of scrutiny. So you may not be able to avoid income taxes, but definitely you can achieve certain estate tax advantages. So those sort of things can be done. People who are mobile, people who have the ability to move cross border, either themselves or with their family, a lot of more options open up if you're able to move to jurisdictions which hopefully don't tax you, something like let's say Dubai, Hong Kong, or other jurisdictions, maybe even a Singapore, which has a good capital gains tax regime and otherwise a low tax regime. There are further things that can be optimized, which maybe in India may not offer you. And I see a new certain countries coming up with radically new regimes, something which is known as a digital nomad. I know Costa Rica has come up with a sort of a plan where even if you stay there for 2 years, they're not going to tax you. They'll give you a visa to stay there, work there for a couple of years, and you don't have to pay taxes on your global income. So I think this is an evolving space, and with things moving to the home zone, work from home, work from anywhere, we'll probably see a lot more regimes. But yes, getting a US green card or a passport in that sense becomes a slight deterrent because it still holds on to the taxing rights, even though they are not physically there. But having said that, there are enough opportunities to look at from a personal standpoint, and things can be definitely planned around.
Thanks a lot. I think that pretty much wraps up all the questions that I wanted to ask. But now we've seen a lot of questions come in from the audience. So I'd like to pick one by one, if that's okay with both of you. And I'll just read out the question, and any one of you, Sridhar or Lloyd, you can elect to answer it. First one, I think this is for Sridhar. For ODI through a company, is the limit of 100% of the net worth be considered, or the limit is still at 400% of the net worth?
Yeah, for ODI through a company, it's a 400% limit of the net worth of that entity as per its last audited accounts.
Okay, got it. And in terms of how are the taxes as per the DTA with US? I'm assuming they're talking about India. If they invest in a company through an individual or from a company in India to a company in USA, and they're talking about dividends. I'm not very clear what they mean by that, but yeah.
So I'll take that. So dividends, there are different rates for individuals versus corporate investors. So if an individual investor receiving dividends from a US company will generally be taxed at 25%. That's the withholding tax. However, if you're a corporate shareholder and own at least 10% shares in a US company, then potentially the withholding taxes will be at 15%. So 15% if you're a corporate owning more than 10%, or otherwise it's 25% under the tax treaty. As opposed to that, domestic law in the US is 30% on withholding, but the treaty will reduce that.
Right. And somebody's asked that if they've invested in something like the EB5 investment, is it taxable in India and US both? Any dividend or return that they earn on that?
So on the EB5, they may be getting a nominal interest. So that is taxable in the US. In most cases, the taxes will be withheld at source for the individual. So the US taxes would be taken care of. But yes, India would also tax any interest income that they get on that return.
Yeah, I mean, usually it's quite, nominal. It's very small amounts. It does not really move the needle much, is what we've seen. Is the rule that we pay US tax first on US income and India tax first on Indian income, and then report both incomes on both returns a good rule? I mean, is that how it's usually played out?
Yeah, so that's a tricky one, Sridhar. I'll take that because we've done this practice for a lot of people. So yes, if you have incomes on both sides of the border, each country will obviously have the right to tax its own income first. And that is where the sourcing rules come into play. So India will have the first right to tax Indian sourced income. Similarly, the US reserves the right to tax US sourced income first. So in both your tax returns, you will have to pay taxes, first on your local country sourcing, and then you bring in your foreign country income and take tax credits. So that usually is the case, and it's a good rule. Yeah. There are some nuances. Capital gains. If you are living in the US and earning India capital gains, there is a potential for getting double tax, because particularly for capital gains, the sourcing rules that the US has and sourcing rules that India has are at opposite end. India will source capital gains based on where the company is resident, whereas the US sources capital gains where the seller is resident. And seller is defined by where the seller has a tax home. That can get a bit complicated, but in a nutshell, capital gains is one area. If the individual is living in the US and investing in the Indian capital markets, then capital gains is one area where one needs to pay some extra attention. But otherwise, yes, local country income will be first taxed in that country, and then the foreign income has to be added, and appropriate foreign tax credits can be taken.
Understood. One question again on EB5, I think. Can we open a joint bank account overseas along with a minor and transfer 500K through LRS for investment purpose?
Sridhar, you want to take that?
Oh, yeah. So, Shilpa, yes, the minor is in itself a distinct person, and therefore it's possible to club his limit also for the parent to jointly invest, but the minor will need to be a joint account holder, or some form of ownership has to be established to be compliant with the LRS rule to make sure that that his limit is distinctly identified.
Understood. Got it. Yes. So I think there are a few more questions. I'll just pick them up. Some of them have come in the chat window. I would request people to place the questions, please, in the question and answer window instead of the chat. So if a property is sold in India while we are residents or citizens in Singapore, what is the tax implication on the sale made? This is specific to NRIs, I guess. How does it get treated?
So if the person is, if he's an NRI, he's logically not staying in India, Shilpa. So we'll be happy to forego that tax in India because he's not tax resident and it's an overseas asset. But if he's a resident, obviously whatever he earns from wherever will be liable to tax. So if it's an NRI, it's a tricky question. I need to know where is he resident of to get that answer. So Singapore has the right to tax him on that income first. And India, if it's an India, so did he say it's an India asset or
Yes. The property is sold in India. Yeah.
So property sold in India, obviously the gain, like Lloyd said, will be subjected to tax in India on whatever that difference is. So if it's immovable property, it will be taxed at 20% rate on long term, and short term will be at a very high rate of 40% odd. So depending on what period he holds this asset in, it will be a fairly high tax rate for immovable property. For shares, it's slightly lower rate. 10% is the long term rate, and short term rate again goes back to 40%.
Got it. There's one question that's come in, which is, how is the tax rate for rental income from USA for an Indian citizen?
So rental income is taxed as what we call ordinary income. So it depends on the total income of the taxpayer. So if it's an Indian citizen, I'm assuming, and rental income is the only income. Then the tax slabs in the US will start at about 15%, and the peak tax rate is 37%. So depending on what the total rental income is, it will be taxed at graduated rates. And this is only federal taxes. Depending on where the asset is located, you will also have potential state and some cases even local taxes. So, but it is going to depend on the slab in which the income falls. So it will be at graduated rates at ordinary income as per the federal taxes.
Got it. Sridhar, one question that comes up very often is, can an Indian resident gift another Indian resident in foreign currency?
So foreign currency, so let's answer this question slightly differently. Between two residents, exchange control law logically doesn't apply. But if you are buying foreign currency, you will be measured by the limit of $250,000 for such a gift. But the fact that you are sending it abroad makes it a bit more complicated because you have your own limit as a resident, and then you're trying to piggyback on somebody else's limit of $250,000. So you can't double count that limit, or you can't take benefit for this in double counting it. So you will, in an overall basis, be subjected to a limit of $250,000 any which way. And this in itself, the banker won't permit such a remittance in the first place. So he will want you to use only one limit, which is either you get the gift in India and then limit your remittance to $250,000 as a resident, or the remittance can't go in dollars. So let's be clear on that. So you can't gift in dollars between two residents, if I was to answer it slightly differently.
Sorry, I was on mute. So yeah, the other question that's come in is, what are the implications to be mindful of for a US born minor if he or she decides to give up their US citizenship when they turn 18?
Yeah, so there is in fact a 6-month window even there. So before the minor turns 18 and a half, potentially there is an option to get out and give up the citizenship without being subject to the exit taxes. So I think that window is important. Between 18 and 18 and a half is where the minor can potentially decide to give up citizenship. It's more of an immigration question, but yes, that 6-month window is critical, and that needs to be monitored.
Correct. And another question that's come in, a person holding a US passport and stays in India for more than 5 years, does he need to file the APRs, etc., for the investment made in the overseas company?
So that depends on from what source he had invested originally. So if he had invested this from his overseas source savings, the requirement for filing APR, etc., doesn't arise. If he had sourced the original investment from India income, then APR, etc., will apply.
Okay, got it. And what is the taxability in India for income from offshore accounts for an NRI? I mean, is an NRI subject to any taxes in India for income from offshore accounts?
When he says offshore, it means offshore of India or
yes,
offshore
I'm guessing that, yeah.
Right, because if he's an NRI, he's already offshore.
Yeah.
And an offshore account of an NRI shouldn't get taxed in India.
Exactly.
But if the NRI was staying in India and is a resident for tax reasons, then this will be taxed in India. So his period of stay in India will matter to be answering that question fully.
Got it. With respect to FTC, do India tax authorities give credit for state taxes paid in US as well as federal tax?
So the treaty only covers federal taxes. As an individual, you're unlikely to get state tax credit. Having said that, in a corporate context, there have been certain case laws where credit has been given for even state taxes in India. But as an individual, it's largely going to be the federal taxes on.
Correct. One other question, I think a lot of our friends in Bangalore, etc., would be having this question is, how are ESOPs held by an Indian resident of a US company taxed in India and in the US?
Okay, so as far as India is concerned, the ESOP is nothing but a security held by a resident, and if it is an underlying equity share, it will be, so on a disposal of that equity share, it will be taxed as capital gain at that point in time when the disposal of the share happens. But if this ESOP is on account of exercising an employment in India, the point at which the ESOP converts into equity will also trigger a salary perquisite tax in India on that employee, which is more like a withholding expectation from the company as well to do what is called a TDS on the perquisite value that the employee has got at the point of exercise. And from there on, it is capital gain.
Yeah, just to add there, it gets a little more complicated if the employee is globally mobile. So if you've received ESOPs, but he's actually shuttling between, let's say, a 2-year US assignment, coming back to India, etc., then the US potentially could also tax the individual at the time of exercise, depending on how much time the individual has spent in the US during the vesting period. So if you exercised employment in multiple countries, then multiple countries potentially could have the right to tax your perquisite element. From a disposal standpoint, it's really the year in which you are selling. If you're an Indian resident selling shares of a US company, as I said earlier, as long as that US company does not own significant US real estate, the US is not going to tax you on capital gains. You may only have to pay capital gains tax in India. But your perquisite element, if you have done a stint in the US, in most cases, it's not a problem for you. Your employer would have withheld respective taxes in both jurisdictions. So that should take care of your wage income elements.
Right. I think we're almost out of time, so I'm just going to take quick 2 questions. One is can Indians use a collateral in India to take a loan in the US? Is cross collateralization allowed? Cross-border collateralization?
No. So you, as an individual, this is not possible. But if you are a corporate, there are possibilities that exist to do this. But as an individual, no.
Got it. And I think one last question that I'm going to pick up is, can you please talk about deemed tax residency in India and the tax issues around this for income generated in India over a specified limit?
So deemed tax residency is a concept for corporates more than individuals. Individuals, the test follows where you actually stayed. And there can be no deeming fiction there because you've stayed in a country, it's very clear you've been in that country. So if this principle was only around tax residence, then it's a clear line on the number of days that you stayed in India, for example, more than 183 days. But if it's corporates, there is deemed residency on account of effective management of businesses. So if the place of effective management of a business of a foreign company, say Singapore, is effectively managed by people resident in India, then the Singapore entity can be treated as a deemed resident of India for tax purposes, and its global income will get taxed because its place of effective management is situated in India. So that's you have to really worry about that if residents own companies overseas, but all decisions are taken sitting in India.
Right. The poem
of course, there are some thresholds as well. So not everybody gets covered. Only something over 5 million or 50 crore rupees is the threshold beyond which a turnover, beyond which is when you need to measure this. But by behavior, you should kind of ring fence this from beginning.
Understood. I think that was a very insightful session. A lot of questions came in, and a lot of the audience was clearly very engaged. Thanks a lot, Sridhar and Lloyd, for your precious time over here and for patiently answering all our questions. And thanks a lot to TiE Singapore for helping us arrange this, and all of you lovely audience who registered and joined us today and asked us a lot of questions. Thank you so much. I hope the session was useful.
Thank you.
Thank you, everyone.